Good morning and welcome to this Wednesday, April 13th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, yesterday, not so great. Futures this morning, I guess could be worse. Got mixed, bifurcated futures this morning. Dow Jones futures down a bit, S&P futures flat, NASDAQ futures up about 25. So seeing a little bit of strength on the NASDAQ this morning, not so much on the Dow, but most of the numbers pretty close to the flat line. Crude oil, another move to the upside after rising $6 per barrel yesterday. It's up about another $1.50 today. So it's back to $102. Of course, this is way off the high from $130, but still also off the double bottom recently from about $93 a barrel. So crude oil seems to be trending back to the upside at this point. 10-year Treasury yield flat today, 2.73%. And as I mentioned, the inflation numbers yesterday came out, I would say a little better than expected. They were hot on the headline number, hotter than expected. But when you strip out the food and energy, the core CPI came in a little bit better than expectations. Actually, I'd say a lot better than expectations, rising just 0.3%, while it was expected to rise 0.5%. So overall, I think the market got some pretty good news on inflation yesterday, but yesterday was yesterday. Today, we have producer prices out, and they are not so good. Headline number came in much hotter than expected, as did the core number. The headline number rose 1.4%. The estimate was 1.1%. And then at the core level, it rose 1 full percentage point. It was only expected to rise 0.5 percentage point. So definitely hotter than expected numbers today, but not quite as hot yesterday, at least on the core level. So definitely some mixture there in terms of the inflation news. Before we get into any of that, though, today, let me take everyone over to Earnings Beats. Of course, this is mostly for those of you that are new to Earnings Beats. I always like to start off my show with an invitation to join our free Earnings Beats Digest newsletter. All you have to do is go over to earningsbeats.com, scroll down, and you will find it right here, kind of in the center of the page. Name and email address is all it requires. There's no credit card required. You can unsubscribe at any time. This is a newsletter I publish 3 times a week, Mondays, Wednesdays, Fridays. Try to get it out by about 8:30 in the morning on those days. So try to give you a little bit of time before the market opens to digest it and think about, whatever is being discussed. Might be a trading opportunity. Of course, if it is, it's completely up to you. Sometimes these are pretty aggressive trade candidates. Other times it's just looking at an index for insights. But again, once you sign up, you'll be part of our community. We have a lot of free events. We reach out to this group for our free events, giving room instructions, recordings, things like that. So I think it's a great opportunity just to learn more, and maybe just, you may already be really good with the market. Maybe there's something that we do that might help you in your arsenal as you approach the market, either from an investing or trading standpoint. Anyhow, go to earningsbeats.com, scroll down, and you'll find it there. Let's move on to the action from Tuesday. Dow Jones Industrial Average finished down 87, S&P down 15, NASDAQ down 40, mid caps down 3, small caps up 7. So you might look at that and say, well, we went through an inflation report, and that's not bad at all. Well, it was a lot worse than it might appear on the surface. And that was because after the CPI report came out yesterday for March, it came out at 8:30 a.m., futures took off to the upside. And if you weren't watching the action yesterday, we had a very significant gap up. All of our major indices were up over 1%. We had a huge move up in the first 20, 30 minutes. Looked like things were going to absolutely explode to the upside. And just as the S&P 500 hit its 20-day EMA from underneath, all the sellers jumped back in. And we saw selling throughout the day. And all of those early gains, the Dow Jones Industrial Average, I'm not sure exactly what it was up, probably 400 points. S&P 500 was up to 40, what was the number? 45? no, 44.70. I don't know. I'd have to, we'll look at the numbers in just a minute. But anyway, we finished back down below 4,400. It was not a good look. We ended up back below all of our moving averages at the end of the day, even though we were threatening earlier in the day, trying to break above some of them. Just didn't pan out. And we saw distribution pretty much across the board. From a sector perspective, energy did well because crude oil prices were up $6 a barrel. So energy took another jump to the upside, up 1.66%. It seems like it's getting a little toppy here around $80. I could look at this a couple of different ways. I could see equal highs, rising lows, a really bullish ascending triangle, or I could look at that nasty looking PPO. As we keep going higher, the PPO rolling over. Looks like price momentum is slowing. So I would just say this, let's see if we can get a breakout above 80. If we do, that's bullish. If we don't, and we go back down below the 20-day moving average, it could be a quick drop back to either 50-day, which is sitting at 72.65, or even to the recent price low down around 70. And if we go down there, we're talking about roughly a 10% drop in energy. So I don't know which way we're going to go. That's not good, I guess, for a technician to say that. But energy's had such a run, and with slowing momentum, it wouldn't be a horrible thing for energy to pull back. I'm not saying it can't go higher. I think that there's a lot more risk in it right now to be in on the long side, but we'll see what happens. Let's see if we can close above 80. Utilities have been very strong of late. You can see this huge move up since the end of February. That February 24th low. This has been your best performing group. Utilities have been very, very strong. Discretionary, not so much. Discretionary, you can see back below its moving averages. Its 20-day moving averages rolling over. Still above the 50, so we haven't gotten that death cross. But when you see this action where the 20 is below the 50 and price action is below the 20 and you get a bounce and you get that golden cross, but it only lasts for a week or two or three, and then goes right back, rolls over again, and the price action moves lower. That's not a good look on the charts. Certainly appears to me like we are rolling back over, and that's not really what we want from a bullish perspective. Financials down a little over 1%. They, couldn't get back through the 20. You can see they've already gone through the 20 to the downside. The 20-day and the 50-day are starting to diverge again, with the 20 starting to accelerate to the downside. Price action beneath it. That is definitely not a good look as we head into earnings season for the banks. I'll talk about JP Morgan in a little bit, but JP Morgan missed their earnings estimate. They're down in pre-market. They were looking not so great on a relative basis over the past several months heading into this earnings report, and we're finding out why now. Healthcare, you can see down yesterday about 1%, so this was another rough group, but healthcare had been strong for the past 2 months, very similar to utilities. Nice move off that February low. We did break out. Pulling back to the 20-day moving average shouldn't be that big a deal. That'll be the level to watch to see if we hold the 20-day on the XLV. 10-year Treasury yield. Let me give you an update. It was pretty much unchanged at the open. That's still pretty much unchanged, down maybe 1 basis point to 2.72%. As I mentioned earlier, March PPI out this morning, hotter than expected, up 1.4% versus the anticipated 1.1%. Core PPI up 1%, which was double the expectation of 0.5%. Tomorrow, we will get initial jobless claims. Retail sales will be out tomorrow, and then consumer sentiment. And consumer sentiment is the one that I like to follow because it has a pretty good track record of predicting recessions. And when it is free falling, and it has currently been free falling, let me get you that. Always forget it. I have to pull it up. There it is. It's dollar UMC SENT. So University of Michigan Consumer Sentiment. Dollar UMC SENT. But anyway, if you pull this up, I like to just pull it up on a monthly basis, and we can go back. Let's go back 40 years. Don't need the volume. And I'll pull it up with a rate of change of 12. So that's 12-month rate of change. So what we'll do here is we'll look at the readings on the UMC sentiment. You can kind of see the big drop here. See 2007, 2008, the big drop there. 1990, that was the Persian Gulf War. I mean, this looks much worse than what it did in the Persian Gulf. Persian Gulf, we had one big drop and the bottom was in. Here we had one big drop, little rally, and then another big drop. Somewhat similar maybe to 2007, 2008, although that was just really a massive drop. Maybe a little bit more similar to 2000, 2001, drop, rise, and then drop again. But anyway, my point here is look at the rate of change. We've gone down 30% in the consumer sentiment. Again, we're getting another reading tomorrow. But right now, we're down 30% over the last 12 months. Only two other times in the last 40 years have we seen this. 2008, 1990. Both times we had recessions. Obviously, the 2008, 2009, that was the Great Recession. 1990 was much milder, but they both led to recessions. 2001, we got down to -20. That was a recession. 2020, the pandemic, that was a recession. You can see, I mean, we're down in territory where we have recessions. Now, maybe this is going to be different. Maybe this is the one time that's different. I don't know. But we're talking about inflation. We're talking about recession. We've got, the war right now with Russia and Ukraine. We've got the Fed that's very hawkish, talking about, severely slowing down the purchasing process. And they're going to try and get rid of their balance sheet, try to offload a lot of those securities off their balance sheet sooner rather than later. They've said they're going to raise rates up to 12 times, maybe 50 basis points next month. Hey, I don't want to be the bearer of bad news, but we got a lot of bad news. Now, when you look at the stock market, there's an argument that, well, some of it, maybe all of it, is being priced in right now. We were at 4,800. We went down to 4,100. The stock market went down on the S&P 14 or 15%. Many areas of the market down 20, 25, maybe even 30% or more. So, yeah, I mean, it's bad, but the market's pricing it in. That's what the market does. So I don't worry so much about the news. I focus on the market to see when the market is giving signals that it is ready to resume its move back to the upside. It's really hard to make that, to read that signal right now. I'm not reading that signal that we're ready to take back off to the upside. And yesterday was just one of those days. I'm going to show you let me think how I can set this up. From 10 o'clock to 4 o'clock, 6 hours. Maybe what we'll do is set up a rate of change for 6 hours. So it's an hourly, or excuse me, this is a minute. Let's never mind. Let's go to the hour. Do I want to do? No, I want to do this one. So this is a 10-minute chart. So how many minutes are in? That'd be 6 hours. That's 360 minutes. So 10 minutes would be 36 10-minute periods. Is that right? Sounds right to me. Let's see what this looks like on the S&P 500. So from 4470 down to 43, that should be about 2%, a little less than 2. Yeah, that looks right. 36 periods. So what I want to do is just show you, and actually let's make it 39 periods. That would be from the opening bell. This will tell us from the opening bell to the closing bell, basically how much the market went down from open to close. Now, this news that came out yesterday, better than expected core CPI rate, should have really played into the hands of the more aggressive areas. And it did at the open. We saw technology, consumer discretionary, communication services, financials, industrials, all doing better than their counterparts, the more defensive counterparts at the opening bell. Look at the XLK, and I want you to focus not only on the start of how things went at the beginning of the day, but then I want you to look at the 39 period rate of change, because that'll basically calculate the difference between the opening price and the closing price. So let's take a look at XLK. So we went down about 0.4% from, that's a 39 period. I thought it was going to be worse than that. Let's see if it's lower than the others. Anyhow, XLK minus 0.46%. XLY plus 0.2%. You can see it was going down, then came back right at the end of the day. XLC minus 0.85. XLF minus 1.09. XLI minus 0.16. We'll go to defensive groups. XLV minus 0.99. All right, that's not telling me what I was looking at. XLP positive 0.03. XLU, all right, positive 0.4. And XLRE minus 0.29. I think overall the aggressive groups did worse. I know I looked at this at about 320, and that was probably when everything was down at its worst. So maybe it was just, from what I recall, a little bit worse than actual. But still, the numbers were down from the open across all of our aggressive groups except the consumer discretionary area, which was up just a little bit. Actually, that's showing plus. That's not giving me what I want from open to close. So 6.5 hours. There's 3 10-minute periods. There's 6 10-minute periods of 36, 39. Maybe it's because it's taking it. Let me try 40. Oh, well, wait a minute there. Okay, there we go. Let's try 40 here. Still not right. Well, let's go back to 36 from that 10 o'clock time period. All right, that's 1.97. That's probably from up in here somewhere. What was the XLK? So XLY was minus 1.97. XLK was minus 2.21. Okay, I think this is going to work out a little bit better. Communication services minus 2.20. I'm looking down here in the bottom left corner. XLF minus 1.75. XLC minus 2.20. So most of those were down around minus 2%. If I look at utilities, utilities were up 0.5%. Consumer staples down 0.25%. Real estate basically flat, 0.02. Healthcare, I think, was probably one down a little bit, down 0.75%. But do you see the difference from 10 o'clock in the morning? If we go back to that XLK, so the initial reaction to that consumer inflation report, the March CPI, the initial reaction was what we would expect, right? The growth stocks, XLK, XLY, XLC, all getting off to a good start. Looked like, okay, here we go back to the upside. Everything was overblown. Inflation's not that bad. And then from about 10 o'clock Eastern all the way through the close, the market said, okay, we're going to sell technology and we're going to buy utilities. We're going to sell consumer discretionary. We're going to buy staples. We're going to sell communication services and we're going to buy healthcare. We're going to sell financials. We're going to buy real estate. It was all this rotation that was taking place. And, another way to look at it, if we want to compare XLK and utilities, just do XLK colon XLU. Now, this isn't the relationship that I typically would look at, but I mean, probably be industrials versus utilities. But anyway, here is the early action. Do you see how the rotation in the very early part of the day? I always talk about the first hour being amateur hour, and what really truly is happening in the market. Look in the afternoon. This is like a poster child of that. The morning, we had everybody reacting to the inflation news, driving areas like technology higher. And then throughout the balance of the day, we saw the exact opposite. Wall Street was moving out of those areas. How can I get excited about the market right now? I'm bullish. Believe me, I'm bullish long term. I'm just looking for signals. I'm going out of my way to look for bullish signals, and I'm having problems finding them. So we got good news in inflation, and it lasted all of 30 minutes before everything set back in. We were right back to yesterday's low on this relationship between the XLK and the XLU. And we've been downtrending because aggressive groups are leading us to the downside again. Anyway, I could go on and on. I won't. I'll stop there. Let's talk a little bit about We're going to talk a little bit about the consumer discretionary area. And I'm going to start off with the hotels. You know, if this was a movie, I'd probably start off with, discretion advised for all bowls. You might not want to look at this, may not be pretty, but these are the discretionary areas of the market. These are the areas that sell us the things that we want, not the things that we need, but the things that we want. And in a good economy, these are the types of groups that normally do really well. That's why if you look back since the secular bull market began on April 10th, 2013, that was the day we cleared the two peaks from 2000 and 2007. So that was the day we really legitimately confirmed that we were in a secular bull market. That was the day we broke out, April 10th, 2013. Since that time through yesterday's close, the best group by far has been technology, but the second best group has been consumer discretionary, because in a secular bull market, interest rates are low, things are great. People, for the most part, have jobs. They're able to pay their debts. Everything is good. They're okay with spending money. And so discretionary stocks do well. Well, I want you to look at the chart right now on these discretionary groups. I'm just going to go through them pretty quickly. On the top is the absolute price chart, and on the bottom is the relative price chart versus the S&P 500. So I want you just to look as we go through at I'm not going to go through specific numbers. I'm just going to tell you the chart, and you can kind of just focus on these two. Is it going up? Is it going up relative to the S&P 500? I would say hotels flat. Let's look at auto parts. Auto parts, I'd say trending a little bit lower, but flat. Autos, this is probably one of the better groups. Autos, same kind of thing to the auto. Actually, did I do the auto parts or did I do autos? No, there's the auto parts. I'm sorry. So when I said auto parts first time, I brought up autos, just habit. I hardly ever look at the auto parts index. So anytime I start typing, I type that AU at the end instead of AT. Anyway, this is the auto parts. So auto parts definitely going lower, absolute and relative. Then we had the autos. Autos are more flat, maybe down slightly. Business training and employment agencies. Think about this, strong employment. I mean, we got low unemployment. You would think that business training and employment agencies would be hopping. Price action, downtrending. Relative price action, downtrending. Gambling. How many gamblers we got out there right now? Well, apparently fewer than we had a year ago. Gambling index been going down, relative strength going down. Clothing and accessories going down, relative strength going down. Specialized consumer services. I'm just going to keep typing, and I'll just let you know when I get to something that's other than going down on both charts. There's your furnishings. Here's your footwear. There's home construction. It's falling like a rock. Household products. Home improvement retailers. Apparel retailers. Broadline retailers. Recreational products. Recreational services. Specialty retailers. Restaurants and bars. Travel and tourism. Toys. And tires, which, by the way, have been moved from staples to consumer discretionary. That change was made recently. I just went through all the charts. As far as I could see, the only one that looked reasonably strong to me is automobiles. That's all of the consumer discretionary groups. Why is Wall Street treating this group so badly? I've been talking about the XLY, XLP ratio for a while. Let's look at that on a line chart. So here's the line chart of the XLY. This is the companies that sell us the things we need versus the companies that sell us the things we need. Wants versus needs. When you're in a good, strong market, the wants outperform the needs. When you're in a bad market, the needs outperform the wants. Here you can see the XLY XLP ratio topped in November. If you remember, the S&P 500 topped the beginning of January. Look at what this ratio was doing as we were heading to a new high. Why? Why, if you're breaking out the new highs, would you be looking at consumer discretionary underperforming consumer staples by a wide margin? Why would that happen? Well, it just does. And if we go back, if we use this ratio, go back weekly, let's go back 15 years. Oh, let's go 17 years, back to 2005. I want you to look at this ratio. If you remember 2000 and in October of 2007, that's when the S&P 500 topped right here. I'm going to go back even further. First of all, let's get off the volume. We don't need volume. And let's go back 20 years. Because you can see during the latter part of the bull market that was a cyclical bull market within a secular bear market. And you can see how weak it was. I mean, throughout much of this, the XLY, XLP is just going sideways. It's really not even gaining much ground. But anyway, we started going down. In October or maybe November of 2007, this ratio, and this would have been right near the top of the S&P 500, this ratio was breaking to about a 4 or 5 year low. And here we peaked and started coming down before the, everything set in at the beginning of January. I mean, we were already down to, close to a 1 year low when we hit the top. But here's the other thing I want you to focus on. Remember, the S&P 500 bottomed in March of 2009, not in November. The S&P 500 actually went lower from November to March. But look what this ratio did. Do you see how the rotation went back into the XLY, even though prices kept going lower on the S&P 500? That was a bullish signal. Look at what we're doing right now. We haven't gone to our new low yet on the S&P. We haven't taken out that February low. And look where we are. Breaking down to a new low on the XLY, XLP. This is why I said I'm not seeing signals to call the bottom. And I believe we're going to get a bottom. I think we're going to get one if it's not this month or next month, probably over the summer sometime. There's going to be a bottom in place that's going to be tradable. And I'm excited about it because I think the end of this year and next year, I think we explode. Because I believe inflation, while it's gone on longer than I certainly expected, I thought it was going to be much quicker. The Fed thought it was going to be much quicker. I still think it's pandemic related. I don't think that this is a structural kind of an inflation that's going to be around with us for many years. I just don't see it. I think a lot of it's created out of the pandemic. We had a surge in demand a year after the pandemic began, and we didn't have the supply. We've had supply chain issues, still people trying to catch up from everything we went through. I think this is all related to the pandemic. I think it'll eventually get through the system. And when it does, inflation will naturally come back down again. Interest rates will come back down again. Our economy will be fine. And growth stocks are going to love that environment. Going to love that environment. Right now, they don't like it at all. The Fed's being hawkish. Inflation still surging. Look at the PPI report this morning. We got signs pointing to a recession, and Wall Street is taking notice and obviously taking a lot of precautions. So we need to as well. Anyway, I could go on and on. That's enough. Let's talk a little bit about the earnings. In fact, I'm going to make this the 3 you must see so we can wrap the show up. First, got to talk about JP Morgan. JP Morgan came out this morning with their first quarter results. Pull it up on a relative chart so we can see what's going on. First of all, look at the AD line. That can't possibly give you any good feelings before you look at anything else. Now, this is not my primary indicator. This is a secondary indicator. So I don't look at the AD line and decide whether I'm going to buy or sell, but I do have it at the top of the chart for a reason, because I think it's important when you're looking at relative strength, you're looking at price performance. I think it's also important to look at the AD line. So normally what I'll either do is put it here, or I'll have the PPO here and I'll have the AD line right below price action. It's usually one or the other. Anyway, JP Morgan downtrending, AD line horrible. Relative strength, here's where we peaked all the way back in September and October. We've been trending lower. Last month, we've come back up, but it follows a very steep drop. So I could still draw a trend line across here, and we're still in a downtrend as far as I'm concerned. JP Morgan down 3% pre-market. Let's see. This is just, let's get an update. Market just opened. So right now, JP Morgan down, wow, almost 4%, 3.79%. It also opened below the low in March. We need a recovery today. This is not a good open. I don't like to see opens below key closing support. Just like on the flip side, I'd love to see breakouts and opens above key resistance. So not a good look to open for JP Morgan. And this kicks off the earnings season. This kicks off the bank earnings that we're going to see here over the next few days. Really, banks over the next week or two. There'll be most of the banks report. Will report by the end of this month. But a lot of the big ones will be reporting between today and tomorrow. Anyway, JP Morgan, not a very good reaction. Don't like this chart and the look here. Delta Airlines reported today. Okay, so good news is they beat their estimate. Also, good news is we gapped up and we did take out this short-term resistance area. So some good news. The bad news is, even though they beat earnings estimates, the earnings estimates were for a loss of $1.28. They lost $1.23. So, you know, it's kind of like looking at two things that are really ugly and saying one's less ugly than the other one. So they had a less ugly report than expected. I don't know that I would say it was a great report, but it did at least beat estimates and the stock's up. Overall, airlines going down. Overall, the AD line here's weak. Relative strength, Delta, to be quite honest, is actually one of the better airline stocks. So if they had come out with a bad report, probably would have been pretty bad news for the whole group. But anyway, they did beat, they did react positively. And this is one of the things we look at during earnings season is earnings reactions. It could be that airlines are one of the groups that are treated the best coming out of their earnings reports. Delta is getting them off to a good start. Now, will it hold into the close, or is it just a gap up? In other words, we're going to sell off and be down by the end of the day. Well, we'll find out. The last one I wanted to bring up is Bed Bath & Beyond. We'll wrap up the show with this one. Ugly report. They were expected to have a 2-cent profit. They lost 92 cents. AD line, pathetic. Relative price action versus specialty retail. Well, they had a little bit of a move there, but for the most part, it's been downtrending for almost a year. Not a good look here. And we did gap below that gap resistance there. I don't know, not very good, down 11.7%. So not a great reaction there. All right, that is it for me. We got a lot more earnings coming out. Do want to remind you that Friday, the stock market is closed for Good Friday. So we got a 3-day weekend coming up, yippee. Maybe get some golf in, hopefully. That would be for me anyway. Anyhow, I want to wish everybody a great day. Tomorrow, I'll be back over at Stock Charts TV tomorrow morning at 9 a.m. for the next Trading Places Live episode. So if you want to join me, just go over to Stock Charts TV at 9 a.m. tomorrow, click on that, and it'll bring up the show. Everybody have a great day. And well, I got one more day before the weekend, but anyway, I wish everyone a good weekend ahead. Take care, everybody. Happy trading.